once you get the SaaS up and running, you can payments on top of that, and then you can improve your retention metrics. And so that thesis kicked off in 2017. I did a deal called FieldEdge, which was previously called, these two really smart search fund guys bought Desco, converted to SaaS, so they would get a SaaS conversion multiple, and then basically got a couple turns of, I'd call it ARR, but really revenue at that time, based on the fact they were running several $1 billion worth of payments through this platform. And that sort of kicked off a focus for me anyway in that market.
Hey, Glen, thanks for coming on the show.
It's a pleasure to be here. Thanks for having me.
Hey, Glen, how does one go from being a mechanical engineer to a flashy investment banker?
By accident, I think. I was a mechanical engineer for all of 2 seconds. I think I graduated undergrad in South Africa, left, went to the UK, became a software developer. It was the Y2K era. And they couldn't find enough people to fix the date stamp in computer systems. And my first job was a Oracle DBA, which is basically just data crunching, and then became a Java developer. And then because I was living in the UK, it was toward the end of the 90s, I was sent out to the US to figure out this web thing. It seemed like it was going to become more of a pattern than an accident. I moved out to the US, ended up staying. Early 2000s, we were building web libraries to encapsulate front-end code, which later became frameworks that are fairly common now. I thought I could build a SaaS company from scratch in 2004. So I went to business school to figure out how to actually build and run a business. And coming out of that, I realized I needed a job. It was a toss-up between banking and private equity, or sell side versus buy side. And I have to say, I was a little bit, underwhelmed by the buy side. I just remember at the time, as an internship during my MBA program, I was processing SIM after SIM, and I was thoroughly bored by that, and ultimately became a banker and then created SIM after SIM. So there really is no escaping the SIM, or known as a confidential information memorandum. And so I started as an associate for CIBC and worked my way up. I think I was just too stubborn to quit. Most people quit around associate or VP and then go to the buy side. I just committed to the role and hung with it. And fast forward, 17, 18 years, and here we are. I get to wear sweatshirts to work now.
Winning.
It all paid off for the sweatshirt.
100%. That's what it was all for. So just break it down a little bit, because I know the first time I raised a good amount of capital, we didn't use a bank, and the second time we did. I think for a lot of people listening, they probably don't understand the role you play. And I think it's something that doesn't get talked about enough in early stage, like what role a banker plays and why they are important and how they can actually help you. Where everyone talks about cost, not many people talk about what bankers actually can do for you and why they could be a good thing to have in your raise or exit event.
Yeah, fundamentally, you have to look at what a banker does. M&A bankers, bankers come in all stripes, right? So you could be debt, equity, M&A. So for bankers that focus principally on M&A, typically sell-side M&A or capital raising, which is a variation on roughly the same thing, where you present a business to the market and try to achieve maximum valuation and then structure around a deal. And really depends on what you think a banker ought to be doing. My version of what a banker ought to be doing is making a market. Depending on what type of business you're running, the banker needs to know where the demand is for that type of business. And so who's going to write an equity check versus who's going to buy the entire business? That could be a financial sponsor or a strategic. But in terms of just pure capital raising, you have to, depending on what you're looking to do, the size of check, the structure of the deal, and the demand for the business, there's certain pockets of interest or demand for that particular type of deal. And bankers ought to know where it is. Now, you as a business owner or business manager could know where that demand is coming from. You could have had inbound interest over time and have built relationships, but you don't or ought not to truly know where all the demand is, given that's not your principal function. It is the function of a banker to know where the demand is coming from And not all interest is created equal, frankly. And for better or worse, we older bankers have spent enough time in the market to understand who are the better investors, who does what they say they're going to do, who offers better terms, for what reason, what's the investment thesis, et cetera. And sure, you can do it on your own. But given that it's either the first time you've done it or certainly you've got other things, better things to do, higher value added things to do, you may want some help with that. Now, that's not to say you shouldn't or can't do it on your own. In fact, if you think you can, or in some cases where you're a serial entrepreneur, you happen to know a good deal about market making and the investors you trust and know. And so in that case, you may well have a short list of folks that you would go to raise capital. But unless you're a well-known entity as a manager and founder, you tend to be in fairly safe hands with the sell side or banking representation.
Just a follow-up question on that, Glenn. There is a notion that the bankers are part of obviously a ecosystem that exists in the wider context, but it's only really for larger SaaS businesses. So as an early stage founder, should I be investing in these type of relationships? And if so, why?
Yeah, I would say depending on who you're talking to, certainly folks at larger organizations, larger banks are going to spend their time with you for a number of reasons. And it may not be monetary at the stage that you're in, or at rather, at an early stage. I tend to focus very narrowly on a handful of subsectors, and I tend to be less stringent around the size of the companies that I talk to, because I find that the smaller companies have a lot of good market intel, which is effectively what we trade in. And so I will oftentimes work on banking goodwill with young companies to offer them advice that they may or may not want, in the sense that it may not be something that business owners want to hear. Certainly when it comes to metrics and growth and anything that would affect valuation, telling someone that their baby isn't quite as beautiful as they think it is a challenge, right? Because you, as a banker, you could end up, that could be your last conversation, and you generally don't want to affect that outcome. So you have to tread this line between being helpful and honest with being diplomatic, but also not BSing what you're talking to. Yeah, I would say a good banker will talk to young companies, give them solid advice, and stick with that company if they truly believe in the future prospects of that business until they are ready to raise a significant amount of capital, or they're looking at a meaningful exit in terms of a sale.
I think that's really good tip, right? If there's something that's really difficult to do when you're an early stage, or even as you're growing, it's to benchmark whether your metrics are actually good or not good. Because when you're in the moment, you're doing it, they all feel good, right? Like you worked your ass off, you got to 15% growth. You're like, this is the best ever. I ring Glen up and I'm like, Glen, I'm going to 15%. He goes, great, but everyone on average is growing 40. And I'm like, we got work to do. You go back, you can work it out. But it is actually important to know, and I'm using silly examples, but it is important to know whether what you think is good is actually good without having to be saying those numbers to venture capital, private equity people who are writing all that stuff down, recording it, and then judging you against how you go as you go along, right? Because they're building their book on how you're going, how your growth rate's going. They're doing all of that mechanics in the background. So they're not the right people to be bouncing off whether you are good or not good, in my view. That's where someone like you can help.
Yeah, there's really no right answer, because when you're a young company, any growth is good, right? Because you're in survival mode and you're trying to grow as efficiently as possible and with the resources you have available. I think some of the more challenging conversations we have is around expectation. And when you're in survival mode, you obviously can't have outrageous expectations in terms of the value of your business. As also, when you're doing particularly well, your expectations versus the quote unquote the market may not be aligned. And that's your point about benchmarking. There's always exceptions to that. And as the old saying goes, every pot has a lid, right? So it's just that what we try to handicap to is what the broad market is willing to accept, how the broader market views certain performance metrics. And we've been wrong on occasion, right? Every banking has made a wrong call at some point, certainly, about the prospects of a business that, may have a higher valuation, some unseen, hidden strategic value that a banker hasn't seen. But in general, we are ordinarily right because we're really just a synthesis of every conversation we've ever had on both the buy side and the sell side. And it's important to benchmark, but take it from when it comes. It is an average or a median by definition. And it's important to understand as a business operator whether you are above or below the median so that you know what to expect when you talk to somebody who you expect to write a check into the business.
I think that's the important part. At least you know where the average is. So then when you do go negotiate or you are thinking about what it is, you're like, speaking to a few bankers, this is where the market is sitting. I think I'm worth X. Why? Why am I worth X? Okay.
It's always good.
And that then becomes a part of how your pitch deck should work because, okay, the average is this, everyone's this. Why am I worth this? These are the three key things that I'm going to really focus in when I'm pitching to people on why I am worth X, whatever that may be. And like, I get this whole difficult conversation thing because you had to have it with me 1,000 times and I kept telling you I'm worth 100 times and you kept telling me I'm not.
I could be wrong. I could be wrong. You could be worth 100 at least in your time. Yeah, look, veering into another sort of topic, which is how to pitch your business to capital providers. And I think another reason to perhaps get some outside counsel, specifically from a banker or folks that are in the market frequently, is around how to pitch that story. Now, you certainly don't want to go online, and you can go online and find pitch decks. You can find examples. The reality is that markets change and what investors are looking for changes. Their appetites change. The hot topic of the moment changes quarter to quarter. What a banker, and this sounds self-serving, but for better or worse, and we see it daily when we help folks write their pitch decks or a fireside chat deck or their sims or what have you, we know what works and what doesn't work. Importantly, we know what doesn't work. And when we review the first draft that comes from a business and we read through it, it's almost always somewhat obvious to us what is the wrong approach in that book. And so we try to rearrange delicately, but it's always a tough thing to tell someone again that this thing that they've been creating, this narrative they've been creating, this pitch that they have given perhaps before, is likely to fall flat because of reasons X, Y, Z, and they're invested in it, and you don't want to push them away, but you don't want to let them walk away ill-prepared either. And so a lot of what we do is, frankly, client management around how to prepare to talk to strangers about the merits of their business. And it's not just financial metrics. There's intangibles. There's some genuine, concrete industrial logic behind someone raising at a ridiculous multiple. But what is ridiculous to some is perfectly sane to others. And the challenge is to figure out to whom is a quote unquote ridiculous multiple sane and why, to your point. And to put that into an orderly narrative that makes sense to the reader, giving the reader credit for actually understanding what you're talking about, not explaining from ground zero as if you're explaining to a 10-year-old. I would say have a banker review your pitch deck for free if you can, or write one and pay them. But if you're going to pay them, certainly make sure that the value that they deliver on the back end is or exceeds their fee or whatever the agreed compensation is.
Just want to pick your brain here a little bit more, Glenn. So I'm an early stage founder. I've got to the $10 million ARR mark in Australia, New Zealand market. We've found our local product market fit. Obviously, we need to now get to the North America because that's what everyone keeps telling us to do. From your perspective, having seen this many a times, what is your advice? What are the tactical tips, even from like pitch deck to everything else? What do I need to look out for that's going to set me up for success as far as what you have seen and what you continue to see?
Yeah, I think fundamentally you have to understand the market into which you are entering and the reasons for it. So again, I've never done it myself, but I've certainly spoken to many folks that have, interestingly, come from Australia or New Zealand into the US market. In some cases, the US market is so wildly different from usually a regulatory or compliance point of view, that they'd be better off going to, say, the UK as a first step. In other cases, the tech is so universally applicable that there's almost always a product-led growth strategy behind business, meaning your product, your platform looks a lot like the US equivalent. The incumbents may be deficient in certain ways that you've compensated for. Step one, I think, is to find local talent to obviously organize the business locally. They need to have an understanding of the market and preferably have done it before in that market. And so you can certainly see mistakes made where there's a lack of understanding of how the US market works relative to Australia, for example. And it's not to say that you're facing a catastrophe if you maybe miss some elements of local conditions. However, the US market's so big that we see it time and again. Australian companies are almost always very well organized products, tech products, are almost always very well thought out. But for some minor differences on the margins, they are fully capable of competing. I would say the exception to that would be if the market here in the US is fully penetrated or mostly penetrated. There are some very large incumbents that are effectively able to outspend new market entrants. And you as an Australian business operator don't necessarily understand those dynamics. You could be running into a buzzsaw that is pure sales and marketing spend. And at that point, watch out. It could be a very expensive mistake. But I would say if the pitfalls to avoid are obviously lack of understanding of the customer base here in the US, lack of understanding of the competition here in the US, and then certainly, thirdly, lack of understanding of capital markets in the US. And I would say in that case, it's more typical that Australian companies are less likely to take capital. The US model is to grow at practically all costs. It's a winner-take-all model, certainly in software and in vertical markets specifically. And Australian companies may be too conservative, I would say, whereas they could arguably raise more capital than they have and go for broke, as it were, in order to achieve full market penetration. And so those are the basics of what we've seen. Beyond that, you obviously need local talent, and that's not necessarily a slam dunk, although I think there's a large Australian contingent here in the US now, which can, for the most part, solve that problem for any fresh or new entrant to the US model from Australia.
Glen, you've narrowed in on the field services sector predominantly.
Right.
Why
for better
field
or worse.
service? Yeah, for better or worse, right? We ask ourselves that question all day, every day. So why field services for you? And then the second question I'm going to ask you both at once. And what are the trends and the shift you're seeing in that market in particular?
Yeah. So field services for me was part by design, part by accident. And it's really all related to my early career coverage of retail tech. So retail tech in the 2000s was principally on-prem brick and mortar store technology. Think point of sale, ERP, inventory management, that kind of stuff. That later evolved late 2000s into teens into e-commerce enablement. And so e-commerce platform Shopify emerged, Demandware went public. There were several M&A trades that happened as consolidation, obviously, of e-commerce tech in the early to mid-teens. I switched firms toward the end of the 20-teens, around 2017. I was just looking for a couple of things. One, at the time, I believed that a lot of investment capital had gone into e-commerce enablement, and it just wasn't coming out. The environment was such that there were really 500 or so logos to compete for that mattered here in the US anyway. Firms with more than customers that had more than, say, $1 million of revenue online. That tail became very long after 1,000 names. It became a lot of small. And then Shopify obviously proved that point by picking up hundreds of thousands of small sub-$1 million GMV vendors. I also remember the 2008 financial crisis and how that sort of impacted the investor mindset when you're operating in a market that is very susceptible to consumer discretionary spend. And you have a variable model, as retail tech for the most part did in the late 2000s, where they were taking a percentage of credit card spend and bundling that with fraud protection and bundling that with delivery. A lot of investors around 2010 had this allergic reaction to tech that was sold on a variable model because they knew that in a downturn, effectively revenue shrank. It wasn't contractually recurring, etc. Toward the end of the 2010s, the big phenomenon of integrated payments started really taking hold among SMB software vendors. And so you went from e-commerce enablement, Shopify with payments, to plumbing software with payments, to software with payments, to tattoo parlor software with payments. Any type of SMB, local SMB business that could run software was ordinarily being sold software with payments. And that had effect two ways. One, it made the software more sticky because when you're running payments through your software, you're less likely to cancel your subscription. Also, it gave upside to subscription revenue, which arguably was month to month for the most part. And so the whole investor world started paying attention to all of the industries that hadn't yet been SaaSified, frankly. And certainly among the SMB software, so FSM is a good example. Resi FSM, which is essentially selling to anywhere from one guy to 10 trucks, servicing a local region, town, plumbers, electricians, HVAC guys. That software became very attractive. It was formerly all on-prem. So there was a SaaS conversion cycle that hadn't yet happened. And then there was this integrated payments thesis on top of that. Once you get the SaaS up and running, you can payments on top of that, and then you can improve your retention metrics. And so that thesis kicked off in 2017. I did a deal called FieldEdge, which was previously called these two really smart search fund guys, bought Desco, converted to SaaS, so they would get a SaaS conversion multiple, and then basically got a couple turns of, I'd call it ARR, but really revenue at that time based on the fact they were running several $1 billion worth of payments through this platform. And that sort of kicked off a focus for me anyway in that market. Prior to that, there were a handful of enterprise FSM deals, which really had no payments attached. And then at least two earlier FSM, Resi-based FSM deals. Help Desk, I think, went to Home Advisor, and Kicksurf went to Reach Local at that point. And so the entire investment market here in the US started looking at formerly, I won't call it antiquated, but certainly as yet unpenetrated market from a SaaS point of view to which you could bolt on payments. And that's largely Resi FSM. Commercial FSM is a different animal. That is less payments. You guys know that better than anyone. Fewer payment opportunities. There's actually fewer credit card swipes, although there's plenty of payment opportunities. It's not as many credit card swipes in the commercial market. And then enterprise is a completely other market. And so hopefully that answers the first part, why I got into it. It's just opportunity, really. And then going forward, I think that supply chain integration, and to some degree, value chain integration is going to be, I think, a much bigger deal where you have very narrow markets where there's one or two large suppliers of equipment, parts, materials generally that have all the pricing power in that market. I suspect that the handful of FSM platforms that are very much dedicated to a market are going to look to those suppliers as logical exit points. where the software vendor is a natural channel for online sales of those supplies, and they may be competing interests for that asset, which essentially presents or ought to present a strategic valuation for that business. And that I think is common in several areas. Roofing is one. There's a handful of manufacturers, somewhat fewer national distributors. Pools, I think pool service is going to be another. When there's really only two suppliers that matter. It's Pool Corp and Heritage. Commercial food equipment, I think is a third. Middleby being a large brand owner of equipment in that market. And on, I think commercial providers are going to probably lead the way in that trend in the next several years. And the extent to which commercial FSM suppliers can integrate to procurement networks or create a procurement network, they then can monetize the flow of goods through their distribution channel, which is, direct to service technicians. Cannot clip credit card swipes, but likely can take a cut of B2B sales by linking up with suppliers in very narrow and vertical markets, I think.
Thanks, Easter, for the payments, just doing it a different way. Who's it?
Right.
I tell you what, even being commercial didn't stop me getting 1,000 phone calls about payments and integrating payments into our commercial platform. Right. Yeah, it was legitimately everyone leaned into it. It just became the in thing for a period.
Yeah, but those folks calling up commercial vendors for which there is really no credit card payment opportunity, they're self-selecting out in a way, right? They're informing you that they don't really understand the markets unless there's something in that market that I don't understand, which is perfectly plausible. But I haven't seen it yet.
We still all have payments. It's just not a massive revenue generating system. It wasn't back at the time when I was around, but I guess it was a door opening phone call, right? Every single person was having that phone call. And like I said, and that's from the banking side who do a lot more of the actual data analysis work before they reach out, more from the private equity and venture capital side.
I figured it out, again, a little bit by accident. I had a plumber come and swap out my heating system in the dead of winter one year, and I live in Boston, so it was quite cold. And when I asked him, how would you like me to pay for this? He was indifferent as to the tender type, the credit card, check, cash, which was surprising. And so when small business owners really don't know or don't care about the interchange fees, you just knew that, this is back in 2017, you just knew that this sort of flood of interest was coming. But I think most folks are wise to it now. It's still obviously a vital service. But interesting, isn't as prevalent in Europe, right? Because in Europe, there's a lot of direct bank transfers, less interchange opportunity, less chance for revenue generation. Europe, they have to focus on the quality of the product and the software, and they build very good software businesses in Europe. Growth is certainly an aspect of it, but profitability as well. So a slightly different take than here in the US, where it's just grow as big as you can, as quick as you can.
Interesting segue to what are you seeing in the market now? Like, I obviously still speak to a lot of people in this, and growth at all costs, which I never quite got right because I never grew at all costs. I was always profitable. But it seems like there is a little bit more focus coming back now. At least the narrative is talking a little bit more about how we need to make money. There might not always be enough money to continue to grow as fast as we wanted and make mistakes. Now we want to see you actually make some cash. Do you think it's a knee-jerk, short-term reactionary change that's going to go away? Is it? What are you seeing?
I think it's a reaction necessarily to the debt markets per se, but certainly interest rates rising. I think globally it's had a cooling effect on the flow of capital. I think the public equity markets cooled off. You could tell beginning of Q1 of 22, the public equity market started cooling off. That had a delayed but direct effect on private markets. Multiples started coming down, and then it was a question of, okay, let's wait and see how far multiples come down from a principal investment point of view, looking at opportunities. And I at the time spoke to a number of investors that had the capital, were looking to deploy, but weren't quite sure where the floor was in terms of pricing. And the knock-on effect there is that as the economy, or at least the capital markets, cooled, access to capital became a little bit more difficult, certainly. Then rates started rising. And so obviously things like venture debt became very expensive, and cost of capital generally became more expensive. Less willingness, I think, to burn every last penny to the ground, and the value, the premium shifted from growth at all costs to profitability or responsible growth. And the rule of 40, which turned into a rule of 30 at some point, presumably a rule of whatever became the focal point, but they had to be profitability at some level, because private capital providers were not prepared to fund burn indefinitely, certainly without a clear line of sight to where global and regional economies were headed, and with valuations coming down. And it all makes sense, but it really does have a feel to it that it's a bit of a herd mentality. Mid-21, everyone was willing to pay 20 times ARR until they weren't. And when they weren't, it was 10 times ARR. And now I think for a lot of companies that are burning or break even barely, and maybe a rule of 20 or 30, it's single digits ARR, but for a strategic bid somewhere. And I think that, yeah, there's just certainly a premium now on profitability. And I think there's fewer investors that are willing to fund losses indefinitely. And that's what you're seeing in the market currently.
Just on that though, Glenn, like, why should those big macro trends affect a sector like field services? Because everyone I speak to, even here, I'll just give you a real example. 2 days ago, I was telling Sean this. Our pool people called, and then they no longer can service our pool because they cannot find enough staff. My point being here is the field service sector and the trade sector, construction, is going bonkers. So shouldn't field services, SaaS businesses, still be in a position to demand the high valuation and also grow at the rate they've always grown at, because there's no slowing down? There is no slowdown, not as far as I can see.
You're talking about a couple different things there, right? You're talking about labor dislocate, which means rising costs of labor and or lack of sufficient labor to fulfill the service demand. And so, yeah, you would think in order to compensate for either the higher priced labor or the lack of sufficient labor, you need to get better utility out of your labor, i.e.
and systemize your business. Yeah.
Right. Supplant that with software.
Yeah.
And that's before you even get to AI, right? So so the software is becoming more useful to business owners, therefore more valuable generally. And so you would think that sales would be an easier sell, and provided that the market exists, meaning that you're not fighting your next nearest competitor and spending an inordinate amount on your customer acquisition costs, you ought to be able to grow relatively efficiently. And I think that will ultimately show up in your financial profile. High growth, low burn, perhaps profitable. And so, yes, that's true, but that's not always true. And so really it comes down to management. How is management prepared, and the board prepared to fund the business, grow the business, in what segments? I don't think it's a catch-all. I think that there's a lot of pockets of opportunity, but field service broadly perhaps is a little bit more competitive now. I think you've seen some consolidation in certain markets. I think HVAC, plumbing, electrical 5-6 years ago was still relatively open and was attractive because the average revenue per business here in the US, at least, was around $800,000-$900,000 per business on average, which may seem low, but on a relative basis compared to the average landscaper, the average landscaping business at the time was around $250,000 a year on average. Just so happens there's a lot of landscapers because it's relatively cheap to buy a lawnmower and start mowing around. So I would say, yeah, the opportunity is still there, but the market's becoming more saturated, which means you're now competing for every customer win. And then the C squared is becoming more challenging as well, right? Because customers, ultimately the consumer of the service, is, yes, to some degree a price taker because there's just not enough people to do the work. But they also, you can only push them so far in terms of high prices, lack of service, disappointment, etc., before they say, hey, to hell with it, I'll do it myself. And field service is always going to compete with the DIY segment. And there isn't an unlimited capacity for services businesses to grow indefinitely. And there isn't an unlimited capacity for field service management software companies to grow indefinitely. There is a cap at some point. There's some level of penetration beyond which that next marginal sale will be more expensive, which will affect your sort of profile. So, yeah, I think there's plenty of opportunity still. I think we feel it as consumers. On the resi side, we feel it. It's hard to find a plumber. It's hard to find someone to mow your lawn. In fact, it's just hard to find someone to do it at a reasonable price. And you would think that's a trickle down, right? Because you're paying twice to have your lawn mowed or twice as much to have your pool cleaned. You can, as a software provider, charge twice as much. But yeah, I still think there's a lot of runway ahead. And I think it's still a great market yet.
It's super good for it. And I've had a whole bunch of trades. I'm building a house. I've had a whole bunch of trades through. None of them use software.
That's right.
Not a single one.
That's right. But the question is why, right? Is it they tried it, they don't like it, they think they can get away without it?
And there's bits of that. Bits of they tried it, didn't like it. And there's a lot of I'm doing okay. Some of them have I'd never even spoken to anyone. Didn't even think about. There's still a huge market in field service that needs to be educated and informed and get to that level, which is what excites me still in that space of construction and field service. There's just so much to be done there that hasn't been done.
So I would look at construction and FSM slightly differently.
True.
Obviously, the mode is slightly different. Construction is obviously installation. You're building something from scratch. It's ordinarily project-based work, whereas service is one time, come and fix something.
Yeah.
I would say this, that there's a difference between general contractors and subcontractors, at least here in the US. My understanding is that GCs run on very thin margins, 2 to 10% range. Not a construction contractor, but this is what I hear. Whereas the subs, because they're making so much money, because they are price setters, and consumers, certainly at the low end of the totem pole, just folks that infrequently receive service and don't really understand the pricing, they are going to pay whatever they can or have to get a problem taken care of. The margins in service businesses now, I think, are well inflated over what you would have found, say, 10 years ago. This is on a margin basis. So relatively speaking, margins are up. And the anecdote that I've heard from multiple sources in the software industry that focus on construction and trades, specialist trades, which are effectively the subs. Subs can do construction or service, is that the subs don't care about software because
they're making money.
Margins are so good. Yeah. Why change it? Whereas the GCs in construction really need to manage every penny in order to either maintain or expand margin, which are razor thin margins. It's the same reason that retail grocers need software. They need to optimize every last sort of basis point of their margins. And I think it's because the subs are making such fat margins, relatively speaking, that they don't necessarily yet care about software. But if we ever get back to a world where service margins contract and there's some environment, I would expect interest in software to actually increase.
So time's always the best trust, right? Things get hard, we sell more software.
That's right. And because it's such good times to be a subcontractor or just any kind of service trades or service organization or tradesperson, because there's so much demand and not enough skills to go around. I think you're not thinking about software as much as you're thinking about doing your job. That trend will reverse, ironically. And you'd see a ramp in software adoption over time.
That's right. That's where Ricky's point comes into it, right? We're hitting, there's two components to software driven field service, and particularly in subs. It's margin, which is pretty high, but as discretionary spend reduces, which happens in a poor economic climate, they will reduce because there isn't as many people going, I want to renovate my house or I want to fix this thing anymore, because they're like, I'll hold on as long as I can because I can't afford it. That will bring margins down slowly. And the second thing is labor shortage. And so you can only make so much revenue with the amount of labor you've got. And then at some point in time, there's a block there. And so the two things that I always look for in field service is difficult times or labor shortages. Because then you've got an angle to go talk to these people and go, hey, it's going to be hard to maintain the money you're making if you keep losing a guy and this guy's now gone over here. And it becomes competitive. You want to keep an electrician, but your competitor wants that electrician, and so the wages you're paying those electricians increase. So yeah, margins increase, but the cost of actually holding talent and staff has increased. These two things working at the moment are what makes me excited about the field service, in particular the subs market. There's a nice wave coming, which should be good for software companies.
Yeah, and it's not just field service, right? The field service to me is service delivery. The cost component that you mentioned is the labor. And so workforce management, managing the global deskless workforce, I think is an interesting segment to pay attention to if you're an investor, because ultimately finding technical talent or any skilled labor is certainly one element of it, but keeping them happy, satisfied, gainfully employed, engaged, understanding, being flexible around schedules and lifestyle that it seems everyone has accustomed to during COVID, that these elements are now important, right? So you have to manage staff, but not manage them as nameless, faceless numbers on a spreadsheet, but as people. And the service world, frankly, doesn't exist without people, hardworking people that really need assistance to get through the day. And there's a lot that software can do to assist them. I think about it in terms of hindsight and foresight. So if someone gets a job, what's happened at this job before? What's the service history of this equipment? What do I need to know? What parts do I need? What's the likely, then the foresight, what is the likely problem if I don't yet know, if there's no error code or what have you? And so that's connected work or service augmentation or connected work augmentation. Those things are also, or will become equally important as there is this labor crunch. And then here in the US, I don't know if Australia exhibits the same trend, but there's a general aging out of the
status workforce
population, right? I think the average age of a plumber is in the 50s now. I think I read that somewhere. What kid coming out of high school or college, their first thought is to go into the trade? Sadly, I think they ought to be thinking about it. Mike Rowe has a point. I think there's a lot of stability, and there's a lot of good jobs in the service trades. And you don't need to be running the business to benefit from it financially.
We do that different here. People are pretty happy to come out, finish year 10, go to a trade school, get a trade job. It's a good career choice.
It's celebrated.
Celebrated.
Yeah. In the US, as far as I can tell, again, as an observation of the average sort of attitude towards the trades, I think the trades are looked down on slightly a little bit here in the US. And unless that changes, we're going to see an aging out and all of that experience is just going to walk out the door. And unless you start to try to capture some of that in some digital form, there's just a ton of expertise that is going to be lost, which is too bad. So, but hopefully software and other more advanced systems can really compensate for that. But it starts really with training.
Or else there's
new generation.
There's plenty of Aussie and Kiwi plumbers that can come to the rescue, mate. Another question.
Forget sending the software. Just send the plumbers.
Send the plumbers.
Send the expertise, send the trade. I do want to pick your brain on this one other question that I have, one that I don't understand too well, and I'm sure the listeners would also benefit from it, Glenn. What is debt funding? Like when the transaction happens, there's a lot of money that goes into this business that's raise funding. And then there is this thing called debt funding. What is it? What does it actually involve?
Yeah, so think about it like financing your house, right? You can finance it either with equity, cash you put in, or a mortgage, which is debt. And so debt comes in various forms based on the seniority that on your balance sheet, really. But ultimately, a lender will lend capital, cash to the business on certain terms. And those can be straight term loan, obviously over a certain period of time, like many mortgages, fixed interest rate, you pay it off, you can have a balloon payment. Ordinarily, there's sort of covenants involved, depending whether it's bank debt or venture financing, which is not equity, but debt. And then you get that intermediate security, which is preferred equity, which looks a little bit like debt. It comes with a coupon or an interest rate, which can either get paid out of cash flow or accrue. And so really there's this thing of a continuum between equity, which is straight cash into the business with no bells and whistles, and straight debt from a bank. And then somewhere in the middle, you're going to see a crossover from preferred equity into sort of venture debt with a bunch of terms and covenants around the debt to straight bank debt. Ordinarily, debt financing is collateralized. So your home is, your mortgage is collateralized by your home, meaning if you don't pay your mortgage, the bank takes the house. And it's true of most real estate. In the software world, there was a trend, I'd say 7, 8, 9 years ago, to start financing loan with revenue. And so revenue lending, or essentially not just revenue, but taking debt against your subscription revenue, which was contractually reoccurring, meaning there was either a single or multi-year contract where a customer was obligated to pay you a subscription for software, and that is obviously more stable. And if you looked at the retention churn metrics, a bank could assess the risk that company would not be able to fulfill its obligations around debt repayment based on effectively an annuity stream of subscription revenue. And at the end of the day, debt comes in many forms. There's different types of lenders that will lend under different circumstances with different terms. It's generally considered cheaper financing than equity. And that's because equity investors invest a little with the hope of making a multiple of their cash investment 3, 4, 5 years down the road, whereas debt investors will, or lenders will lend on fairly fixed terms, less risky, but lower return relative to equity. Therefore, the debt is technically cheaper from a business owner's point of view than the equity. Does that answer the question?
Very well. Yeah.
Oh,
I understand it much better now.
There you go. Someone will complain about that explanation, I'm sure, but
hey, I understood it, so that's a win, right? You actually taught one person, and I'm sure there'll be someone else listening, and we'll gather the same. Would love to take you through a quick fire round, Glen.
This is the important part. This is what matters.
This is important, and there's only one answer. I know some have gone down this route of multi-choice. Doesn't quite work that way.
I probably should have prepared for this, but these are
just whatever comes to mind first.
Reactions.
Yeah, first reaction.
That's what you want. Gut reactions.
Even the dog's getting all excited. Favorite sports team?
Springboks, of course.
That was an easy one.
Especially this year, right? Anyway, we
won't. Did they win? Did they win something? I can't remember. Did they ever win?
A lot of this can be edited out too, so there's no problem. You can say as much as you want. You can diss as much as I don't even. Was there a World Cup on the show?
No.
Are you talking about last one?
Yeah.
You know what? I had trouble watching those games live. When you win everything from the quarter to the final by 1 point, that's stress-inducing.
It's brutal.
Cardiologist requested that I stop watching live games.
So on to the next one. Favorite music type?
You know what? I pop. Whatever's the latest pop. My kids, as long as it's clean.
Whatever.
I can play it in the car for my 5-year-old daughter.
Swift. Yeah.
Get a lot of Taylor Swift requests lately.
Yeah.
So we'll take 2 Swifties here. That's 2 Swifties.
Okay, finance guys, mate.
I'm not a Swiftie, but I'll fake.
Swiftie. That's fine. You only just go to every concert, but you're not a Swiftie.
Yeah. If he takes the shirt off, underneath it is a Taylor Swift shirt. He's just hiding it.
It's an Iron Maiden shirt. Actually, no. My personal preference when my kids aren't around, I would say is probably hard rock. I think there's still some room in everyone's life for good old-fashioned hard rock.
100%. That's all my kids listen to when they get in the car.
Yeah, Metallica. Why not?
Yeah.
AC/DC.
Nice.
Sure.
Like my kids listen to Slipknot and stuff like that when they're in the car with me. But anyway.
My kids request TNT, AC/DC.
Yeah.
The point where I'm sick of it. I'm like, guys, let's go with it this time.
Nice. What about favorite movie, Glenn? Do you have
It
one?
has to be Top Gun.
Top
Gun?
Gun.
Is there another movie?
Rolled off the tongue. Yeah, that's straight.
Yeah,
Top
I like
Gun.
it.
Fair enough.
Yeah, look, I'm a child of the 80s, right? Grew up in the 80s. Top Gun, one that probably sticks in my head the most, I would say. And then the reboot, sure.
Yeah. Yeah.
It actually wasn't bad. I'll give you that. Like, I expected it to be shit, but it was
It was good. It was
all right.
Flop, but it was
Yeah.
good.
It was good.
good.
It was good. You walk out, my basis for what is a good movie is do I feel better walking out of a movie theater or having watched a movie now, because no one goes to movie theaters, relative to when I walked in. So I don't watch horror movies because I generally walk out feeling a lot worse. Yeah, like any feel good at this point. I think we all need reasons to feel good. Yeah, Top Gun was the last one I actually went to go watch in a movie theater. It felt great.
Nice.
Love it.
Good. You've just come back from a holiday, but favorite place to visit? One. Just one.
Yeah. I like Thailand, to be honest. I like
It's come up a
Southeast
lot.
Asia. To me is great. It is relatively unspoiled by Western consumerism. You can still get away from the hustle and bustle. It's 15 hours ahead of the US, so it's very difficult to be reached when you're sitting on a beach and not sleeping. It's great. I travel Southeast Asia with my wife on one occasion, with buddies on another occasion, and just sitting on the beach staring at the waves is, I don't know, in the sun.
Nice.
Feels good.
Can't go wrong.
Feel like every day of my life. But yeah.
Good food, good beer.
You don't all
Every
live
day.
on the Gold Coast. Okay, we don't all live on the Gold Coast.
Yeah.
Sunshine Coast, depending on.
Oh, exactly.
Gold Coast is
Your
different
preference.
about it. You got it right. You got
Yeah. If you're into nightclubbing like Sean is, then Gold Coast is much better. If you're for a cruisy lifestyle, head up north.
When in Rome, right? You just got to
That's
do it.
experience.
That's right,
it. Basically, this is the main one, Glenn.
Sure.
This one, we know you're going to get it right. There's no pressure, but there is pressure. Peanut butter. How do you like yours? Crunchy or
Crunchy. Crunchy.
You don't even...
I didn't even need to
Or
think
just
about it.
know,
Look at
just
that.
know,
Bam,
just
straight in.
Bam.
There is no other version. The other
That's right.
version, stick to the roof of your mouth. Weird goop. Like, what's the point? I don't get it. Why wouldn't you put crunch in peanut butter? Yeah, crunchy.
There is no argument
Do
from
you know
your
what's
side.
really good, right? When people like crunchy, they're straight in, they give you good reasons. When people say smooth, they're like smooth because smooth.
Oh, my kid made me do it.
Yeah.
There's
Yeah.
always some
It's like it's because you
Yeah.
eat peanut butter jelly sandwiches and you're still at
That's
home.
So we've had
But
that
yeah.
once too. Yeah.
Mhm.
I only eat it with
But-
jelly. I'm like, oh, that's weird.
Nothing, apropos of nothing. The best peanut butter meal that I can think of is there's a restaurant in San Francisco, and I forget the name, but they serve peanut butter in sushi. And that
Never
was
had that.
arguably the best peanut butter surprise I ever had. I'll find the name and share it with you.
My
that's
name,
quite-
it'll go on the
yeah.
list, Ricky. We're doing that. We'll,
Yeah.
we'll
San
live,
Francisco.
yeah, we'll
There's
live stream
a-
that.
There's an
$50,
authentic
a little
Yeah.
tease.
sushi restaurant.
It'll be worth it. Yeah.
Oh,
Yeah.
I will open it up and be like, this is smooth. Take it back. Bring it.
You know what? It had tempura in
Yeah.
it. So shrimp
Oh,
tempura.
right.
So peanut
yeah.
butter, shrimp tempura in a maki roll. Phenomenal. I don't think I cared if it had peanuts in it.
Yeah.
It was. I'm not a peanut butter guy, by the way. Reese's Pieces, no thanks. But yeah, sushi with peanut butter was great.
Nice.
It's on the
Hey,
list
yeah.
now. We'll have to have it.
Exactly.
Perfect.
Glenn, thank you once again for coming on the show and sharing all your wisdom and all your insightful answers to the hard questions. So we much
Yeah,
appreciate it.
Thanks for having me. It's been a pleasure. Always great
Fine.
talking to you guys.